Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include just some random tidbits from this industry and others. My interview with Arcom's Malone on the HELOC market, the need for it, the various products out there, and how it's being utilized across origination channels. And a government shutdown means lower GDP, should mean lower rates, but obviously, every company wants seamlessly integrated best-in-class solutions, optimizing every stage of the loan cycle. That's exactly what ICE does. As the standard for innovation, artificial intelligence, efficiency, and scalability, ICE is the technology of choice for the majority of industry participants, defining the future of homeownership. To see why innovation happens at ICE, visit mortgagetech.ice.com. Let's hope that the Federal Aviation Admission has better security than the Louvre, whose passwords to their cameras were apparently Louvre. I'm sure that the Smithsonian, MoMA, and Vatican IT staffs are busy changing theirs. The FAA manages the world's safest and most complex aviation system. On an average day, it serves more than 45,000 flights and 2.9 million airline passengers across more than 29 million square miles of airspace. Even with the Trump administration lopping 10% of that off, as was announced yesterday, it's still a lot of flights. And many of those air traffic controllers haven't been paid in the past 5 weeks. Speaking of travel, the next time you're waiting to board, watch out for gate lice. Huh? That's people who crowd around the gate by an airport or boarding lanes, sometimes in an attempt to board before their allotted time. But let's talk mortgage. This is a mortgage podcast, last time I checked. In the wholesale arena, United Wholesale announced its third quarter financial results, closing $41.7 billion in production, its best quarter since 2021, which consisted of $16.5 billion in refinances, up 33% year over year and 24% quarter over quarter, and $25.2 billion in purchase business. Revenue was $843 million, up 11% year over year and 13% quarter over quarter. $12.1 million in net income, which included a $159 million decline in the fair value of MSRs, and a gain on sale margin of 130 basis points. CEO Matt Ishbia stated, quote, "We set a company record in September for rate locks in a single day and saw a significant ramp in our daily loan submission intake, all while maintaining our high performance standards. We're also on track to bring servicing in-house in January, and we'll deliver the best customer servicing experience in the industry through our strategic collaboration with Built. Finally, while others in the industry are still using AI as a buzzword, we've already generated over 14,000 loans for our brokers with Mia, our AI loan officer assistant." But let's zoom out to the market as a whole here. Trading volume in mortgage-backed securities stayed lighter than usual yesterday, and lower coupon MBS outperformed higher ones, reflecting stronger demand for safer, higher quality bonds. MBS prices generally improved into the close yesterday, with activity picking up modestly in the afternoon as investors adjusted positions ahead of upcoming settlements. Not surprisingly, Freddie Mac reported rates in its latest primary mortgage market survey followed Treasury yields higher. For the week ending November 6th, the 30 and 15-year primary mortgage market survey rates rose 5 basis points and 9 basis points from last week's year-to-date lows to 6.22% and 5.50% respectively. For today's interview, I wanted to welcome to the show Arcom's Malone to talk about the HELOC market, the need for it, the various products out there, and how it's being utilized across origination channels. Arcom, which is a New Jersey-based mortgage lender and servicer specializing in non-QM and non-agency loans, named him vice president of HELOC for its fully digitized Home EQ broker solution earlier this year. In this role, he'll lead efforts around education, strategy, and partnership to help loan originators maximize its value. He brings more than 2 decades of experience scaling HELOC programs, including building a program from launch to nearly $1 billion in annual funded volume.
Lee, I do want to get into the move for you and kind of the why Arcom and all of that, but let's start with a little background for our listeners, and that's me asking you about the HELOC space or the second space, and it's certainly come a long way, at least from a PR perspective, definitely from a product perspective as well. In the last couple of years, homeowners out there are looking to tap into their equity. Some of the taboo surrounding some of these second products has melted away for good reason. People are seeing the help it can give them. They're realizing that the interest rate on these products is way less than a credit card or a personal loan or other debt instruments. When you look at the HELOC market, the need for it, and that sort of thing. What do you see going on right now?
Yeah, Robbie. If today's purpose of the meeting was to talk about how could we build the perfect environment for home equity, I think we could brainstorm together and we could come up with all the things that we see in the market. So customers are locked in at a low rate. You have other factors out there that, they're scared to move because of interest rates climbing where they are. They're not ready to make that jump and lose that 3.5% or lower interest rate. You have um, things going on in the world, right? That's getting people a little nervous and do I move? Do I stay? But the need that is always constant is the need for cash. And borrowers out there are always going to have a need for cash. You have a couple things that kind of play into that perfect environment that we're in right now, where consumer debt is at an all-time high. You have consumers that have ton of credit card debt at very high interest rates. But at the flip side of that is the available equity in the customer's home is also at an all-time high. So those two kind of blend together really well. But you kind of run into that problem of customers not wanting to lose that low interest rate, obviously. So a cash out refinance isn't necessarily the best product for most customers at this moment. So the home equity has really, I guess, blossomed over the last several years from something that was used as more of a rainy day need of maybe I'll need it in the future to being able to turn that into something that a customer can use strategically to either help pay off debt, help improve their equity in their home by remodeling a kitchen or updating a bath, buying a second home or investment property. So they can get real creative and real strategic with the products that are available today that maybe weren't available or weren't in the thought process just a few years ago.
As a quick follow-up to that, just what is out there from a product perspective, especially those products that borrowers might not even know exist?
Yeah, so there's a lot of different ones out there. You kind of break it into three different categories. You have your traditional HELOC providers, so banks and credit unions, and there's a need for that. Obviously, typically it's a lower rate, it's a longer process. Those relationships are already built. You have the other end of the spectrum, like the figures of the world that have a really nice digital process. It's very quick, it's very easy, it's fast, but it's somewhat limited on the pull through and what happens when a customer doesn't fit right down the middle. And then you kind of have those other companies that are trying to package a home equity product into the space, but trying to utilize underwriting guidelines and pulling over a lot of stuff over from the mortgage process. So you have a lot of that out there. You have fixed products, you have interest only products. There's a lot of different things that meet those needs. You have, some that don't require draws. You have others that do require draws. So there's a little bit all over the board, and the products have really expanded over the last couple of years than ever before. Typically it was always kind of your one-stop shop of you get a fixed period of draw and then you amortize it out the rest of the time. Well, that's not always the best fit for borrowers because they have a quick need. They know they're going to maybe sell their home in 3 years, so they don't need a 10-year draw. Things like that are out there. So it's really creative and it's really fit to what the borrowers need and what they expect as far as being able to strategically use this kind of a product for their needs.
Well, you have some pretty unique features at Arc Home as well, and some new stuff that people might not know about. What are some of the features that are unique to y'all?
There's a lot of great players in the space, right? So we tried to take a little bit of what we liked from a lot of those other players and maybe where they kind of lacked or where they, customers would fall out of pull through things like that. We try to take that and say, all right, if we could build the perfect home equity solution, what would that look like? So our process is a little bit different. We start out with an all digital process. So, it could go as fast as a customer wants to go. But if it does fall out, we built a nice off ramp for more of issues where if a digital platform verification of income is an issue for a borrower that works or that keeps their money in a small credit union that's not set up with those digital platforms. We have off ramps where a customer can upload docs or kind of go old school and bring docs in that way, or of course can still do the digital verification. Obviously that's going to go faster, but then we also have built a really nice platform for self-employed borrowers. And I think that's one of the areas that's kind of lacking out there in the home equity space, where if you're a W-2 borrower, great, you can slam one through. But if you get into more of like self-employed type of income it kind of gets a little bit gray. And we've tried to really focus in on that, on updating some of our guidelines to allow more of that type of income, allowing 1099 income, Schedule E to offset mortgage debt for the people that have rental homes, things like that. So we're trying to really get creative when it comes to that space, as being able to do the best of both worlds, right? The person that can fit a W-2 borrower straight down the middle versus someone that has a little bit more hair around the income, and little gray areas around that, being able to provide solutions for both type of borrowers.
You joined earlier this year, so you're still relatively new at the company, and I know you have some exciting things you want to accomplish there. But why did you decide to go make the move, go to Arc Home?
Yeah, I appreciate the question. So I've been in the mortgage industry a long time. Started out as an LO. I worked for Wells Fargo as a wholesale account executive. So I enjoyed working with brokers, kind of providing those solutions for borrowers. And moved from there and kind of got recruited over to Guaranteed Rate. And we started a home equity product from there. We were a good partner with Figure, who is the 800-pound gorilla in the room, right? That everybody knows who Figure is, and they've done a really nice job. Just went public, last few weeks. So a lot of experience in home equity. I worked at PNC Bank as a regional, covering the bank's footprint for the home equity space. So, been on both sides of the world, right? I've been on the account executive side, doing that at Wells Fargo. I've been in the banking side, doing that at PNC Bank, and then Guaranteed Rate, obviously a well-known player in the industry as well, and building that from scratch in the home equity space there. So the move to ARC was an awesome opportunity to kind of to build our own platform, and doing a lot of exciting things. Home EQ is kind of our name from ARC, so it's kind of Home EQ provided by ARC. And ARC Home has a great name in the industry, and kind of looking at it when the opportunity presented itself, a lot about knowing the industry that's out there, knowing the environment that we talked about earlier, that is a opportunity that's huge for our borrowers and our broker partners, and being able to take that into a space at ARC that has never really developed that channel, and being able to drive it from the ground up. It was a unique challenge and a unique opportunity, and I'm excited to be here.
Yeah, so let me get this right. It's kind of TPO backing into the broker space and growing into correspondent, or what's the proper way to think about it?
Yeah, absolutely. So we're starting in the broker space. We have other products that are available for our correspondent partners. But yeah, so this particular product, the kind of the digital start with the opportunity to off ramp anything that goes a little sideways, that's going to be for our brokers specifically right now. We do have plans to move that into the future into a correspondent channel as well. But we want to get it up and going for our broker partners right now. That's kind of our number one goal here as we end 2025, hitting the fourth quarter really hard.
Finally, before I let you go here, kind of best next steps for people interested in more info, or ways they can get a hold of you.
So if you're not set up with ARC, first of all, get set up. You can reach out to us. You can reach out to me personally, and happy to help. My phone number is 502-439-3871, and email is just lmalone@archhome. So happy to help get signed up. It's a unique opportunity because we're a leader in the non-QM space, but then we're also going to have a really aggressive product for the home equity space that I'm really excited about. Being out at NAM last week, or a couple weeks ago, it was great talking to some brokers and opening up some eyes. Some of the features that we do on our product that we're going to roll out is a little bit different. So it was great talking to a lot of the brokers out there and getting that excitement built, and seeing those connections being made out there as well. So yeah, absolutely. Reach out to me, email, phone. Always happy to help. If you have an AE currently, or if you're looking for an AE for the non-QM space, we can get you signed up with that as well.
Well, since you threw out your phone number, now it's public domain. The 502 area code, that's Kentucky, if I recall correctly, right?
That is.
Are you from there? You live there for a while, or what's
I am born and raised in Kentucky. Yes, sir.
Very nice. Well, I in a previous life, I enjoyed going to races at Keene.
Oh, yes. If you're born in Kentucky, you're born with bourbon in the blood and racing in the blood as well. So
There you go.
absolutely no stranger to both of those.
Good stuff, Lee. I really appreciate you coming on. Thank you very much for making the time.
Yeah, thank you, Robbie. Appreciate the time.
You'd think rates would be sinking given the employment picture and continued government shutdown. It's almost as if some politicians want a slow economy, so rates will go down. Sure enough, there's not much to report out there for you this week. Bonds rallied Thursday, easily reversing Wednesday's losses after the Bank of England held rates at 4.00%, but signaled a possible December rate cut. There was a Challenger report showing 153,000 job cuts, which was up 183% month over month and 175% year over year, which drew extra attention due to delayed government data releases. Non-farm employment in October from Revelio Labs reported a loss of 9,000 in non-farm jobs, predominantly driven by employment losses in the government sector. Both those reports improved Fed funds futures odds for a 25 basis points cut in December to about 70%. Today's economic calendar will be missing the usual monthly payrolls report from the Bureau of Labor Statistics due to the government shutdown, which is in its 38th day with seemingly no end in sight. However, markets will receive the preliminary November Consumer Sentiment Report and the September Consumer Credit Report, along with Fed remarks from New York Fed President Williams, Vice Chair Jefferson, and Governor Miron. We begin the day with agency MBS prices unchanged from Thursday's close, the 2-year yielding 3.56 and the 10-year yielding 4.09 after closing yesterday at 4.09%. Let's wrap up with a joke and some housekeeping. Since I was a kid, I've always been terrified of someone hiding under my bed at night. The fear got so intense that I finally decided to see a psychiatrist. "Doc," I said during my first session, "I can't sleep because I'm convinced there's someone under my bed. I feel like I'm losing my mind." The psychiatrist nodded thoughtfully and said, "This is a common fear. Let's work through it together. Come see me 3 times a week for a year and I'll help you overcome it." "How much will that cost?" I asked nervously. $150 per session, he replied. I blinked at him. "That's a lot. I'll have to think about it." 6 months later, the psychiatrist spotted me walking down the street and stopped me. "Hey, you never came back to work on your fear. What happened?" "Well," I said with a grin, $80 a session 3 times a week, or $150 a session 3 times a week for a whole year. That sounds like a small fortune. So instead, I went to a bartender who cured me for just $10. I saved so much money, I even bought myself a new SUV. The psychiatrist raised an eyebrow. "A bartender cured you? Really? And how did he manage that?" "Simple," I said with a laugh. "He told me to saw the legs off my bed. Now there's no way anyone's hiding under there." Thanks again to ICE for sponsoring this week's podcasts. As the standard for innovation, artificial intelligence, efficiency, and scalability, ICE is the technology of choice for the majority of mortgage participants, defining the future of homeownership.